what merging two businesses together would look like, but doing it in a spreadsheet and doing it in reality are two extremely different things. I would say ideally you would want to prepare at least 36 months before you actually go to capital raising, whether that's debt or equity. So in a turnaround situation, it's a little bit more urgent because you have that cash crunch and you need to get it solved right away.
With me today is Bob Church, founder of Sentinel CFO Services, helping founders build the predictable business where cash flow is growing, decisions are clear, and growth is predictable. The perfect business, I would say. Bob, how are you feeling today?
I'm doing well. How are you?
Doing fantastic. Now, before we get into the nitty-gritty, can you tell me first of all, how did you start and how did you end up where you are today?
That's an interesting question. I actually began my career as a forensic accountant for one of the big four accounting firms. So I spent a few years doing forensic accounting, and I got recruited to my first private equity firm who specialized in distressed and turnaround situations. They were looking for somebody with specific expertise who could really dig into the P&L and trial balance and understand what was going on in the business and help formulate the turnaround plan. So that was a great learning experience for me. I was able to really understand business both from the finance and accounting perspective, but then also from the operations perspective. I would formulate the turnaround plan and then actively manage the company through the turnaround. So that was my first real, intro to operations. So I spent a while doing that, and then from there I transitioned to more of a growth-focused private equity firm. So that was my second private equity firm that I worked at, where we really would buy founder-led businesses in the lower middle market, put together a growth plan, and then execute on that growth plan and eventually sell the business for multiples of what we bought it for. I left private equity for a little bit and I did some specialty finance projects for public companies, mostly Office Depot. And then I led a extremely high growth private equity backed startup based out of Miami doing direct to consumer sales. And after successfully growing that business, I got back into private equity. So I worked with private equity firms for the last decade or so, helping them diligence businesses, put together financial and operating plans, and really digging into the operations. And that's kind of what brought me to Sentinel. With my background and expertise, I really saw the opportunity where smaller sized businesses really need the guidance and support that these private equity firms are putting into companies, but maybe they don't have the know-how or access to this type of expertise. So I saw a market need there, and that's what I'm helping people do now.
Interesting. So it sounds like a full circle from
yeah, you could say that.
Awesome. Now, let's break down a couple of pieces there, because I think there are some specialties that people would just assume are done by PEs, but it looks like there are focus and niches. Talk to me a little bit about formulating a turnaround plan. How does that look like?
So most businesses, trying to think of how to explain this. Most businesses are good at what they're doing up until a certain point, right? They're successful, which is why it creates a real business, but they get into trouble because they don't have the right systems or financial guardrails in place. And then that's when the downward spiral really starts. So when we come up with the turnaround plan, we actually go in and we look at the financial statements and say, okay, what are the numbers telling us? Where is the real issue here? And the sooner we can dial in on that, the sooner we can start to formulate the plan, because the longer you let a problem linger, the more expensive it's going to get. So we'll say, what are the numbers telling us? And then we'll look at the operating reports too and say, do the financial statements and the operating reports reconcile? Like, does this make sense? Or is there something getting lost in translation here that the management team is missing? And usually that's where the friction starts, is the operations of the business and the financials of the business aren't fully aligned. So the management teams aren't making the right decisions because they don't have the right data. So that's really the starting point, is let's get operations and finance aligned so that we have the right data. We're looking at the complete picture, and then we can begin making the smart decisions of, okay, this is where we're at. This is how we get ourselves out of this situation, or this is how we grow the situation. And then we basically put together a monthly plan where we just work on specific objectives one at a time. And then eventually that success compounds into turning around into a successful business.
So it's not just working one thing at a time, it's compounding those things so they're aligned, so that they actually compound one after the other. But it sounds like it's not just operations and financing are not aligned, so you're spending more than you're bringing. It sounds like it's a little bit more than that. Is there an early sign that you've seen time and time again that you are not going in the right direction?
Yeah, there's always signs, right? The numbers are always telling you something. So the sooner that you can get on top of it, the better. That's why I'm a big proponent of, if you don't have financial guidance, you should really look into it. Even if you feel like you're at a stage where you may not need it, at least talk to someone. And if you don't engage with them, they at least give you a baseline of, hey, this is how things look. And whether that's me or someone else, getting the perspective of a professional who has seen this and done this before can be extremely helpful. So what I would say is, if you feel like you're growing, right? The revenue's going up, but maybe cash flow isn't following, right? In theory, if revenue goes up, cash flow should go up. A lot of the time we see with clients that that's not necessarily the case. So that could be a first warning sign or indicator that maybe something's wrong. It may not be. Investing in growth can be expensive, and in a lot of ways can be predictable. So that alone is not an indicator that things aren't going well, but that could be an early warning sign that things are not tracking the way you want it to.
Interesting. So it's like you're scaling your problems. You are growing, but you're scaling some problems, and there's some lingering problems. Like you were saying, the longer they are, the more expensive they are. Can you give us an example of problems that typically you see, as you were doing this for so many years, you typically see people let linger around for long and then they become super expensive?
So here's a recent one, actually. I was working with a multi-site healthcare provider. They had a number of locations across the country, and it was the same business model across every market, but reimbursement rates were different. And they never sat down to really analyze the unit economics of their clinics. So they were in some markets that were just fundamentally unprofitable because of the reimbursement rate in that market. And so to your point, if you're growing, you could be growing your problems if you don't get ahead of them. So in a specific market, let's say in the Northeast somewhere, the reimbursement rates were so low that they were making about $2 per visit. So a patient would come in, they would get reimbursed by the insurance company, and at the end of the day, after all their expenses were covered, they were making about $2. Not a great ROI. They didn't fully understand that, so they were putting material marketing dollars in this market to try and acquire new patients, because they thought bringing in new patients was going to fix this problem. What they didn't understand is, if they're spending, $300 per client acquisition to make $2 per visit, and someone's coming on average twice a year, you're spending $300 to acquire a patient where you're going to make $4. Like, that math doesn't work. So they were just compounding their problems by trying to acquire more patients. After working with us, we said, this market's fundamentally unprofitable. You need to talk to the board about shutting this market down, or coming up with some other strategy to increase reimbursement rates or supplement cash flow in another way. But in the meantime, we took the marketing dollars that were being spent in that market and diverted it into markets where they were getting, somewhere between $200 to $500 per visit. So all of a sudden, that ROI and marketing spend makes sense, and we started growing in the profitable market and started diverting resources away from the unprofitable market.
Got it. So it's that, like you said, even if you feel like you don't need to, but having that financial advice will open your mind, or will show you the numbers, what they're really telling you. And in this case, they felt like putting more marketing dollars behind the problem will solve it, where they actually were just increasing the problem, because the more they're inquiring, the reimbursements were not making sense at all.
Exactly. And I guess I'll say this as well. This seemed like a relatively sophisticated company that had raised capital in multiple rounds. Seems like they should have had, sophisticated finance and accounting systems and known what to do. But they didn't fully understand the whole picture. And I think that's why they were just compounding problems.
Right. Now, if you are looking at the other side of that story, where your second, I believe it was your second private equity where you worked, was where you did growth plans.
Yeah.
What is the difference between what you were doing there, and what is the difference between putting together a growth plan from the point of, you probably hit a problem? One is you need to recover it, and one is a different problem. How do you go about that?
That's actually a great question. The underlying principles and the approach really aren't all that different, right? It's, what goal am I trying to solve? What are my problems that are in the way of that goal, and how do I address them? And our approach is the same. It's, what are the financials say? What are the roadblocks or issues within the financial statement that we need to address immediately? And then what are the longer term issues that need to get addressed? And again, you just tackle them one by one. So in a turnaround situation, it's a little bit more urgent because you have that cash crunch and you need to get it solved right away. In more of a growth plan or growth mode, there is cash flow there to support growth. So it's maybe figuring out where is the most optimal growth avenue, or what things should we put in place to further drive that growth. So one, it's a sense of, I guess, not urgency, because you want to grow as quickly as you can without getting over your ski tips. But in a sense, you have a limited runway in a turnaround situation before you hit the wall. And then I forgot what my second point was there.
All right. So it sounds like you're looking for, when you're looking for a growth plan, the similarities are there, but the urgency is slightly different. Yes, you want to scale and grow, but the runway is not that. Here you have a little bit more of a leeway when you're growing, and you need to divert or put that cash flow in the right place to see that growth.
Right.
Do you see a pattern with all the companies you work with? Do you see a pattern where they always want to invest cash flow first for growth?
I think, everyone wants to grow, right? That's obviously the plan, and that's why we get into business. Nobody wants to be at $1 million forever, right? I want to go from $1 million to 5 million to 10 to 100. Everybody wants to get their business to the next step. I think different people, and especially at different phases in the business, are more or less inclined to invest in the business. I think even earlier stage business owners are more reluctant to invest in their growth because they're smaller, cash flow is probably tighter. So I think the pattern might be more of the stage of the business versus the business itself, if that makes sense.
Yes.
But I think at any stage, you really need to consider investing in the business to get to that next level. And that's where having that cash flow forecast, especially a living forecast that gets updated monthly and says, okay, our cash runway is this, our forecasted low point for the next 12 months is this. That gives you a lot more comfort in making these big strategic decisions of, I'm going to invest in 3 new people, or I'm going to invest in this big piece of equipment, or I'm going to open these locations over here. Like, having that forecast provides a level of comfort that you can actually afford to make these investments and get your business to where you want it to be.
Absolutely. And I think sometimes we kind of don't project the right way, because as a business owner, entrepreneur, you're always like really ambitious. So you're shooting for some pie in the sky numbers that are not really, but you're like, we'll do it, we'll succeed, I've done it. So you want to do it in a, I don't know, there is a component of aspirational goals. How do you bring someone to reality to say, I understand what you're saying, these are aspirational, and this is what we can do? How do you have that conversation?
Well, so that brings the quote to mind, like, everybody has a plan until they get punched in the face, right? Everybody starts out like, oh, I'm great at this is going to be great, I'm going to get to $100 million in no time, right? Probably not 100 million, but everybody has this big aspirational vision when they get into business. And then you get into it, and it's a lot harder than you think. You might be great at your profession, but being great at business is an entirely different skill set. So what we do is we'll sit down with you and we'll say, okay, this is where we're at now. You're great at your profession, whether you're an attorney, a plumber, whatever you do, you've been successful at it to get to this point, right? But where is your vision? Where do you want to be? And we'll say, if we're at, call it $10 million right now, and we want to be at $100 million, realistically, can we get there in 5 years? What are the milestones that need to be hit, and the objectives and plans we need to put in place over the next 60 months to hit that objective? Is that realistic? Is it aggressive? And then we'll kind of work backwards and say, okay, if this is where we want to be, how do we put the plan in place? And that's in terms of, team. How many people do we need to get there? What are the financial resources required to get there? Can we do a bootstrap? Do we need to consider capital raises, whether that's debt or equity? What are the resources that we need to bring to the table? And at what point in time do we need to do that to make sure that we can realize that pie in the sky vision?
Now, let's say client is on the other side, and they're listening, they're nodding, they're like, I want to raise capital. They've never done this before. This is the first time they're like hearing this idea, and it sounds like you said you have two options: debt or raising capital. How does someone go about raising capital the right way?
Well, the first thing I'll say is, I think the ideal outcome is to bootstrap it. Like, the less financial pressure you have, the better. However, that's not always feasible, especially if you have aggressive growth plans. Raising capital could be accretive in the right situations. So the first thing that I would do with someone is help think through the pros and cons of that. Bootstrapping versus raising capital, because there's always a trade-off there, right? So is this something you really want to go down? Let's make sure you understand all the pros and cons that come along with it before we start going down that road. And then the second thing I'll say is, debt capital and equity are two very different things. Each has their own pros and cons, so we would go over that as well. What are the pros and cons of each? What do you feel more comfortable with? Because at the end of the day, we don't want you to just become another employee who owns 10% of the business, right? That's not a good outcome either. So we look at that as well. And then the third thing that I would say to anyone who says, I want to go raise capital, be prepared. Your business isn't going to be put on hold. It's going to be a second job. You have your business to run during the day, but then you're also going to have, investor meetings, investor requests. It's going to be a whole additional workload that you probably did not anticipate. And we help with a lot of that, and we help guide you through the process and get as prepared as possible. But there's always additional work and tension that comes along with the transaction.
Right. Now, a lot of people don't know that second part. They see the flashy entrepreneur in Dubai that says, I just did my C round and this is the Lamborghini. Walk us through reality. What do they need to be prepared? They raise the funds. They're like, look, I'm fully aware this is what I do. I have some ambitious goals. I want to be lovable 2.0. You're like, okay, be prepared. What happens now? They raise the funds. What happens next?
There's going to be a lot of poking and prodding of your business. people are going to have a lot of questions. So I would say the more that you can prepare ahead of time, I would say ideally you would want to prepare at least 36 months before you actually go to capital raising, whether that's debt or equity. So you would have a good financial and reporting structure in place, because that's going to make everything that follows just so much easier. If you don't have good numbers, lenders or equity investors are going to, I don't want to say doubt the numbers, but have a lot less confidence in the fidelity of those numbers. And there's going to be a lot more work required to get it up to baseline where they say, okay, these are good numbers, we trust them. And that's going to be both time consuming and expensive. If, let's say, they wanted to get a quality of earnings on the business, there's going to be a real time commitment and cost to that.
Interesting. So the more you prepare ahead of time and be prepared for the poking, for the questions, be prepared that people will doubt your numbers. It's just part of the process. Now,
yeah. So I think this is a good way to think about it. Anyone who's looking to buy or invest in a business, what they're really investing in or buying is the cash flow of that business. So anything that you can do to make your cash flow, look more attractive would be like the stronger the cash flow, the better, right? So more cash is obviously better. A business that's making 100 million in EBITDA can absorb a $10,000 cost a lot more than a business that's doing 100,000 in EBITDA, right? That $10,000 surprise is nothing to the business doing 100 million. If you're making 100,000, that's a meaningful chunk of your earnings. So they care about the strength of the business. They care about the predictability of the cash flow. How predictable is this cash flow coming in? Can I rely on it every month? Is it up and down all over the place? I have no idea if it's going to be 100 million this month and zero next month, even though it averages out, right? How predictable is the cash flow? And then what is the growth trajectory of the business? The more demonstrable the growth, the more willing people are to invest in that growth, because there's a path to growing the cash flow, and that's what they ultimately care about.
At the end of the day, it's how that blue sky, how long can we keep riding this thing and increasing? What is the ceiling at the end of the day? It's interesting how you position it. If you're buying a business, you're buying cash flow. You have a lot of people that are talking on YouTube. They're saying, "Hey, I found this very boring business with all this equipment, and I just bought it, and it's fantastic. It's making me millions." And everyone's like, "Wow, let me try that." And then it doesn't work out that way, because there's different things in that reality. But when someone says, "Look, we talked with you, Bob. I want to buy this company because I don't want to develop all these things. I'm going to buy this company, and the cash flow." Help me understand that cash flow. I feel like it might be good for growth, but I want more like a strategic merger acquisition. What are some of the advices that you give to someone that is ready to acquire a company to grow?
So there's two paths for growth, right? There's organic growth, which would be just doing what you're doing and continuing along that path, or the other is through acquisitions. Again, both have their pros and cons. If you're looking to grow through acquisitions, that adds a lot more complexity and operational risk into the equation. So you need to be prepared to handle that operational risk. We could think through what merging two businesses together would look like, but doing it in a spreadsheet and doing it in reality are two extremely different things. I think that's one place where private equity professionals really don't have a true appreciation of what operators actually do. They think that a business should perform like it does in the spreadsheet, and that's usually not the case. So really understanding how the businesses will come together, operationally, how's that going to look? Can you run everything on one system, or are you going to have to run two separate systems? How is it going to fit culturally? Are you going to be able to integrate personnel, or is there going to be friction there? at how's the team going to look going forward. I think all of those considerations need to be figured out and at least have a plan, so that once you do complete the acquisition, you don't have a lot of fallout or, I guess, unforeseen friction that could really destroy value before you start to see any return on that investment.
Interesting. It's like what you see, the numbers, it's just not the whole picture, because reality is very different. And there was a podcast we did with Katie, and she acquired a couple of companies because she does marketing. Like, one I acquired because they had a superstar. I thought she'll be fantastic with us as well. 3 months in, she resigned. That company was barely profitable for the next year. I was just scrambling to get it to an ROI positive. It was a disaster of an acquisition, but like, you live and you learn through these things. When you are on the other side, let's say you are representing the client that is getting acquired, what are some of the misconceptions that you hear there? Because I've heard some, like the payouts, how long it takes. I sold a company to KPMG and they paid me extra. Like, those stories are kind of like part of the whole thing, not the full thing. So the point I want to make is, if you're on the other side, what are you telling your client what to expect from this merger acquisition?
So if you're on the sell side, I would say, again, be as prepared as possible. I would recommend commissioning your own sell side quality of earnings. Like, just as if you were going to sell your house, you would want to know, like, what are the issues that people are going to have with it before you go to market. So if you're going to go sell your business, you would want to know what are the issues buyers are going to have with it before you go to market, so you have the opportunity to address those issues and correct them so that you can optimize or maximize your exit value, rather than going to market and people saying, oh, I have this issue and this issue and this issue. You know, you thought your business was worth 50 million, but the reality is buyers are coming to you with offers for 20 million, right? That's a big gap. So if we can get ahead of that and say, okay, the business is optimized for sale. And again, that's why I recommend starting this process, 36 months ahead of time, so you can put that plan in place to be prepared when you actually do want to exit.
Interesting. It's it goes back very similarly to raising funds. It's just like, what do you do at the end of the day? You raise from B, and then it's do you become, like you said, like employed with like 10%, and all these things become like really complex. Now, if we go down the path of we're making this like really more advanced. It's not like for the basic small business one. We're going a little bit more advanced. Some people were like, look, you do CFO stuff. Of course, you're not just doing like that. It's also not tax or taxation, but they keep hearing all these ways that these CEOs that are, of course, like the 1% of the 1% of the 1%, they don't take salary. They have no earnings. They take debt on top of the shares. Or walk us through some of those scenarios. What do the top CEOs do when they grow the company? They have a CFO, they have a team, they grow it, and now they're looking to acquire, but they're also doing it in a smart way where the finances, the cash flow, the taxation, their salaries are structured properly.
So there's obviously CEOs out there who have crazy comp packages in terms of just cash comp they're making. So that's not what I'm talking about here, but there's ways to structure your comp package where it's more equity based. And I think for a lot of people, that's where value is created. It's in the equity of the business, not necessarily, the W-2 earnings or the paycheck they're getting every week, every month out of the business. So the other benefit to having your growth in the equity is you'd be taxed at long-term capital gains versus ordinary income rates. So you'd be taxed at a much lower rate. So there's tax savings to that as well. But I think in terms of creating wealth and creating value, equity is an excellent vehicle to do that, because you can really grow the equity value of the business multiples of what your salary would be. So if you own a business, saying, let's say you're doing 10 million in EBITDA right now, maybe you're taking a salary of 300,000-400,000, total comp maybe 500,000. If you grow your EBITDA to 20 million, you might feel more comfortable taking more money out of the business, but you're probably not taking multiples of that, right? But if you grow your EBITDA from 10 million and you sell for 10 times, that would be 100 million. If you grow it from 10 to 20 million and you sell for 10 times, that's 200 million. That's a meaningful difference. So growing that equity value, you're growing it at multiples because of that, I guess, transaction event where you're getting multiples of your earnings, if that makes sense. I don't think I explained that well, but
no, it does make sense, because you're not like, your salary is not increasing, you're multiplying your EBITDA, and then the shares that you have, that multiplies the your equity in the business. So if you start pulling out those shares, like you said, the taxations, all those things, now it's a very different ball game as opposed to that weekly paycheck. Even if you doubled your revenue or this and that, it's not how you would multiply your EBITDA, the equity shares you have in your business.
right.
Interesting. Now, if someone says, this is all fantastic and I want to get on the path, you said 36 months ahead of time, you start to look at these things. Someone comes to you and says, look, we're in a good place. I think we're profitable. We hit the ceiling. Now we need to do some stuff, because I don't know how we're going to go to the next step. How does someone like you, Bob, like a CFO, fractional, or someone in the company, what are the first steps? You're like, look, let me set the road for you to exit in the next 5 years. You're in a good place. These are the steps we need to do for you to exit in the next 5 years. How does that look like?
So if someone's specifically looking for an exit, I would ask them, one, why are you looking for an exit? What do you want to do next, right? Some people want to sell just because they want to sell, and then they have nothing to do. And is that really a good outcome? So one, why do you want to sell? Two, what's the magic with 5 years, 3 years, whatever time horizon they want to sell in? Is there a real reason that they want to hit that? Or is it just more an arbitrary number that they're putting out there? Because that, I think, helps inform the strategy and plan that we lay out. Like if someone says, I have to sell my business in 5 years for XYZ reason, then that would probably impact how we approach growing the business and the plan we put in place, versus someone that says, I want to sell my business in 5 years. I don't really have a reason for 5 years. It just seems good. Right? That might change how we approach things, because there could be incremental value that we could realize beyond year 5, where it would be beneficial to sell in say 7 years or 10 years, where you could really compound growth in those out years. So one, understanding the motivation and the time frame, and then two, we would say, what is the value you want to get for your business, right? Because most people have a number in mind. So is that value realistic versus where you are today? And then how do we get to that value over the whatever the time horizon is? What plan needs to be put in place? What resources do we need in terms of personnel, equipment, capital? How do we get to that valuation?
Interesting. Now, let's say you go through these 3 questions, and you have different people in front of you. There are different clients. In 2026, what are some of the highest growing businesses when you're looking at them, that you're looking at the market and talking with your clients? What are some that have the highest opportunity to keep growing in 2026 and past that?
I think trades businesses are actually growing really well right now. HVAC, plumbing, fire and life safety. I've seen a lot of growth in those industries, but then we've also seen growth with chiropractic practices, dental practices, certain specialties within healthcare, I think, are growing really well. I think overall, it's just been a good market for a lot of different industries. Even our construction clients have been growing well.
So it's not necessarily that you need to jump on the AI bandwagon. There is growth, massive growth in trades and plumbing, HVAC, healthcare. You don't have to all of a sudden like tack on like AI into I don't know, sparkling water or whatever you're doing. Now that we have that in the conversation, do you see people or business owners, CEOs, when they are planning or thinking of their finances, they will say, hey Bob, I talked to ChatGPT and this is what it said. What do you think about this thing that AI gave me as a plan, as a CFO? It acted as a CFO. What do you do in those conversations?
It's funny you bring that up. I have a client who's acquiring a dental practice, and she put her term sheet from a bank into ChatGPT and said, this is what ChatGPT told me. On the one hand, it wasn't too bad, but on the other hand, it was fairly generalized advice that wasn't really specific to the outcome that she was looking for. So I think directionally it was okay, but it lacked the specifics in terms of what the actual steps were that needed to occur for this to work successfully.
The personalized steps, exactly what. So it will give you like what it will scrape from public domain, the direction, but at the end of the day, it's very it's not personalized the way that it needs to, so it can actually happen. This is more like guiding you to the right path.
Yeah. So I've seen other clients do that as well, and I guess what I'll say is it will generalize based on publicly available information that may not be right or specific to the individual using it. So it could, in certain instances, be giving them the wrong information, because that guidance or that direction might be right for 80% of the people, but if they fall in that 20%, it could actually be leading them in the wrong direction.
Interesting. It is the right advice, but not for you, because yes, it's true what it says, but it maybe is not really applicable in this specific scenario.
Exactly.
Got it. Now, let's say someone goes through this process and listens to all these things that you're saying and the way that you're approaching your work with your clients. Talk to me a little bit more about what you specifically do with Sentinel CFO. How does that look like working with you?
Sure. So if somebody wants to work with us, the first thing that we'll do is just have a call with you and understand, if it's even a good fit for us to work together, right? Some people may have the structure in place where they don't really need our help. Other people may think they need one thing, like they may think they want our guidance, but what they really need is a controller or some other technical accounting that we don't really do. So in that case, we would say, we're not a good fit to work together, but go talk to X, Y, and Z. We have a few different outsourced controllers that we work with. So we would refer them to the controller, and then maybe down the road we could work together. But if it is a good fit for us to work together, the first thing we would do is, I feel like it's the same description, but we would understand your financials, where you're at, where you want to get to, why you want to get there, right? What are the driving forces behind that goal or that vision? What are the challenges in the way? And then what are the steps we need to implement and take each month? So we would put together an initial budget of, this is where we're at, this is where we want to go over the next 12 months. And then we would create a living forecast that would say, based on what happened the last month, we think this is what's going to happen over the next 12 months. This is what we think revenue is going to be. This is where we think cash is going to be. And then we would sit down with you each month and say, okay, for the next 30 days, based on what we're seeing in the financials and the plan we created, we need to focus on doing these 3 things. So this month, go focus on generating leads. You're not getting enough leads into your pipeline, and that's why revenue is lagging. Or this month, cost of goods is too high. You need to go back to these 3 vendors and talk to them about your cost structure. So it depends on the situation, but we'll come up with specific action items that they can go take over the next 30 days. And then the next time we'll meet, we'll go over, this is what we said we were going to accomplish. Did we accomplish that? Yes or no? And if we did accomplish it, are we seeing that translate into the financial performance of the business? If it is, awesome, let's move on to the next objective. If it's not, why did it not work the way we thought it would? And what do we need to tweak or change so that next month when we have this conversation, it's green and good to go, and we can go to the next objective.
Very systematical, very clear. It starts with a lot of work, like front end, but then it becomes, like you said, a live document that is updated, changed, tweaked, modified, and then you look at these kind of pointing people in the right direction, because sometimes someone will look at, like the client you were explaining, they're putting more marketing dollars into getting more, but the reimbursements are not making sense. So this is what we can look at and change and kind of course correct to go in the right direction.
Exactly. It seems very simple, and it is, but the only reason it's that simple is because there's been 20 years of work and hundreds of different companies behind it to refine it to where it is now.
Absolutely. And I think we all strive for simplicity, but it's very hard to achieve. So when we do see it, you're like, wow, this is amazing, but simplicity is very hard to achieve. Now, Bob, if someone listens to this whole thing and they like what they hear, how do people get a hold of you to work with you?
They can go to our website, sentinelcfos.com or sentinelcfoservices.com, and click on our booking link and set up an initial call with us, and we can talk through where your business is at now, what challenges you're facing, and if there's a way that we could potentially help you, or if there's someone else that we could recommend that could help with whatever challenges you're facing. But this might sound weird. My passion is helping people grow their business. I don't know why, but I enjoy seeing the numbers go up every month. So whether it's me who can help you or someone I know who can help you, I'm always happy to point you in the right direction, because this is the type of stuff that I enjoy.
That's awesome. That's fantastic to hear. And it's very rare to see that side of private equity and VC. We've all heard like the worst of the worst, but it's always nice to see someone from that world that is smiling and laughing when they're saying, look, I just want to see the numbers go up. I want to help someone's business grow. That is my genuine goal at the end of the day. So I appreciate you saying that, and I appreciate you being here with us today. And thank you for the time, Bob. Wish you all the success, and we should be in touch.